You marked the fair value gap perfectly. Price tapped it almost to the pip. You got in, exactly like you were taught. And then it just kept going. Straight through your level, straight through your stop. So why does the zone price is supposed to respect keep failing? Let me show you why most fair value gaps fail, and how to spot the few that actually matter. Here's what nearly everyone gets taught, and it sounds reasonable. A gap is an imbalance. Price moved so fast it left a pocket where almost no trading happened, and the market doesn't like leaving things unfinished, so eventually it comes back to fill that pocket. And on the surface, it holds up, because gaps get filled all the time. You mark one, price drifts back, taps it, bounces. So traders land on something simple. Find a gap, wait for the return, get in on the reaction. Every gap is a setup, and it feels safe, because the chart keeps proving it. But here's the part nobody tells you. Most fair value gaps are just normal volatility. Every fast candle leaves one, every news spike, every quick push, every bit of chop. So if you mark them all, you don't find a handful of clean setups. You find dozens. Treat all of them as high probability zones, and you're not trading an edge, you're trading randomness and calling the winners proof. Because price filling a gap isn't some force respecting your level, it's what noise does. Price wanders back through old territory constantly, so your gap filling and bouncing often isn't the setup working. It's a coin landing heads and you remembering it. The gap, on its own, tells you almost nothing. Here's the thing though, the gap was never really the signal. It's the move that creates it that matters. And once you can see that, you'll never look at these the same way again. But first, if you're someone who can't sit at the charts all day, the cleanest of these setups can form at 2 in the morning when you're asleep, or when you're simply not watching, and that's exactly when you'll miss them. So what a lot of serious traders are doing now is taking a defined strategy like this and automating the execution. So the rules run whether they're at the chart or not, on a personal account or a prop account, and pairing that with actual one-on-one guidance instead of guessing alone. If that's the direction you're trying to go, click the link below in the description and book a quick call with my team. We'll walk you through how it works. Right, back to the charts. So what is it then? It's the displacement that created the gap. Watch this move. See those candles? Big, decisive, one-directional. That's not drift, that's force. And that force is what left the gap. Now price comes back down into it, and it holds and carries on the way the higher time frame was pulling. That gap worked, but notice why. Not the box. The violent move that made it lined up with where price already wanted to go. Now compare it to a random gap from the chop a second ago. Same 3-candle shape, but nothing made it, just a fast wick in a range. Price taps it and drifts off. Identical on the chart, completely different meaning, and your eyes can't tell them apart unless you look at what made them. Here's the same thing flipped. Higher time frame pulling down. Price displaces lower, hard, leaves a gap, rallies back into it, gets rejected straight back down. Same story, just inverted. The gap that matters is the one with real force behind it, pointing the same way the bigger picture already is. Go back through any week on the chart and label what made each gap, and you'll see it every time. The ones that hold have a violent move behind them. The ones that fail are the quiet pockets left by noise. Now here's the part that flips the whole thing. Watch this one. Price displaces, leaves a beautiful gap, and never comes back. And every trader watching is sat there waiting for the tap that never arrives, while the move runs without them. That gap was the loudest signal on the chart, and they read it as a level to wait at instead of a tell about strength. Because that's the real shift. The strongest gaps are often the ones that don't come back to fill. Real displacement doesn't hang around to give you a tidy entry, so the gap that politely returns and taps your level to the pip is usually the weaker one. You've been reading the footprint and ignoring the animal that left it. So how do you actually use this in real time when there's a live chart in front of you and a gap just formed? Because there's a simple question you can ask in 3 seconds that filters almost all the bad ones out. Before you trust any gap, ask 2 things. What made it, and which way is the higher time frame pulling? What made it? Real displacement, big decisive one-directional candles, a clean break, or just a fast wick in a range? No force behind it, it's noise. Leave it alone however clean the box looks. And the bigger picture, a gap that lines up with the higher time frame direction is worth your attention. One fighting it usually isn't. Here's something to do the second this ends. Open any chart, mark the first 10 gaps you find, and next to each write what made it. Displacement in line with the trend, or noise. You'll be surprised how few survive. Do it 10 times and you'll never see a gap the same way again. Just before we get into the mistakes, don't forget, if you want access to strategies that can run on your rules around the clock, plus one-on-one coaching from our team, click the link in the description below now and join the hundreds of traders already trading smarter with us. Now here's how most traders blow themselves up with this. even after they understand it. They learn fair value gaps work, get excited, and go gap hunting. Every imbalance on every time frame gets marked until there's 20 overlapping boxes on the chart. They take the first tap of any of them, so they're long off one gap and short off another in the same range, chopped to pieces, worse off than before they'd heard the term. The second version's even more painful. They spot an unfilled gap, decide it has to fill, and fade the strongest move on the chart to trade it. Standing right in front of the train, calling it a setup. Same tool, used backwards, doing more damage than knowing nothing. Understanding which gaps matter took about 5 minutes. Sitting there at 2 in the morning with a clean-looking gap in front of you, and having the discipline not to click buy because the displacement isn't there, that's the hard part. That's the exact moment from the start of this video where you marked it perfectly and it ran straight through you. Understanding why is easy now. Living through it in real time, with money on the line, and still doing the right thing, that's not a knowledge problem, that's execution. So that's the shift. A fair value gap was never a setup on its own. It's a footprint, and what makes it matter is the force that left it and the direction the bigger picture's pulling. 10 minutes ago, every gap looked the same. Now you can look at 2 identical boxes and know which one matters and which is noise. The understanding's there. The hard part, as always, is doing it consistently when it counts. So if you want to see how I put a full setup together on top of this, the displacement read, the higher time frame context, which gaps to trust and which to ignore, all the decision making, that's exactly what I walk through in the free training. Just click the link below in the description. Stay disciplined, keep learning, and I'll see you in the next one.